Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey everybody, welcome back to the DIY Wealth Canada podcast. I'm Nelson. As always, I'm here with my co-host Bob. Today we are going to talk stocks. We're going to talk some individual stocks that we might be buying, that we kind of are looking at or have opinions on, or sort of like been in the news lately. Just kind of, we figured we should do a all stock episode of the podcast. We've been doing a lot of kind of like personal finance-y stuff, sort of. So we figured we would pivot over to individual stocks for an episode. And so we got a few that we're going to talk about. Obviously, we're both dividend investors, so the dividend part of it is going to be very, very prominent. But, obviously we'll talk about all the different stuff as well. Bob, are you excited to chime in with some stocks that you're looking at today as well?
Yeah, for sure. I think this is going to be an interesting one because we don't typically prepare for these podcasts, at least, go through our notes. So this is a bit of a free-wheeling, free-talking episode. So that this is going to be fun.
Yes, I'm excited. Okay, so let's start it off with one that I think a lot of you are interested in, and one that is, I know that questions that I get, this one kind of dominates everyone's, sort of questions that they ask me, and that is Telus. Bob, we record these in advance, so this news is going to seem like it's a little bit old by the time it comes to you guys. But as we're recording this is basically brand new news that Telus's CEO is stepping away in, I think it's June 30th, and he's being replaced by Victor Dodig. And I apologize if Victor's listening, if I misspelled his or mispronounced his name. But he's a former head of CIBC, and he's going to be taking over Telus at that point. So, Bob, what do you think about this move by Telus? Do you like it? Do you not like it? What's your thought process there?
I think I generally like it. The current CEO has been at Telus for, I think, 20-something years. I think it's 25. So it's maybe gone a bit stale with the current CEO. Not saying he didn't do a good job, but, maybe some of the decisions he has made weren't great over the years. I think it's all, in generally speaking, it's good to have a new CEO coming in, especially after you have a long tenure CEO. I think the company just gets a little bit stagnant and stale a little bit. I think the biggest worry for people with this new CEO coming is Telus dividends, and everybody, at least from what I read, everybody or majority of the people, the general feeling is that the CEO is coming in and cut dividends quite a bit. And as we know, Telus dividend is maybe not quite sustainable. And there's been a lot of talks because Telus has a lot of debt. And we've seen BCE cut dividends last year in 2025. So people kind of anticipated Telus to cut dividend. They haven't. But this is kind of like another sign that the dividend from Telus will get cut. The Telus stock share price has been going up a little bit since early 2026. And since the announcement, it has dropped down a bit. I think it went over $19 at some point, and now it's back down to about low 18s. Personally, I think, and we talked about this before on another episode, is that I generally think it's good for Telus to cut some dividends, maybe reduce it by, 20, 30, even 50% would be okay. Yeah, it sucks as dividend investors because right now the yield is over 9%, which, by the way, is not sustainable long term, right? So it's better for Telus to cut the dividends and then get their books in order and see if they could turn the company around. And I think that's what the CEO will do. And so, yeah, that's why some people are like, oh, I'm going to ditch Telus. And, for those investors that are purely looking from an income point of view, they're attracted to 9% yield and they haven't really looked at the fundamentals of the company. That's where people are billing. And for us that have investing in Telus for a very long time, we're currently in the red, unfortunately. But it kind of doesn't make sense for us to sell at this point. I think holding on and see the company turns around is probably a good idea for us. And plus, when I look at Telus in our portfolio, it's a relatively small position. So is it going to impact our dividend income overall? Yeah, a bit, especially if they cut 50%. But in the day, that's probably a good move to do. Nelson, what do you think?
I think that there are an awful lot of conclusions that are being jumped to based on kind of one move here. Okay, so I guess I'll start with, do I think bringing in a CEO is a good idea for Telus? Yes, absolutely. I agree with what you say, Bob, where it's like the guy's been in charge for 20, 25 years, or whatever. He stepped away, I think, in 2015 or so, brought in, I can't remember the guy's name, to run things. He ran things for about a year, and then the old CEO said, hey, you know what, actually, I think I want back in. And they fired the new guy, and they brought the old guy back in. So his influence on Telus has been very, very strong for a long time. And it's a good idea, I think, to get a new kind of perspective in there, new voices, even like kind of shake up the culture a little bit, because my understanding is what I've read is that the culture of Telus is very top-down driven, where it's just very dominated by the current CEO. Now, that might be wrong. I'm just reading from the outside. I have no idea. I don't even know anyone who works at Telus, but that's what I've read. And so, ultimately, I think that getting in a new perspective is good. And the other thing, the new CEO, he has experience in kind of this turnaround type of situation. He went into CIBC. CIBC for a long time was one of the laggards of the big six Canadian banks. And he turned it around, and the share price, especially from like kind of 2020 on, has been spectacular. I think it's actually outperformed Royal Bank in that time period. It's done very well. So from that perspective, it's like, okay, like bring a new guy in, you might as well. But I think the issue becomes is when people look at the new guy and they say, oh, the new guy is immediately going to come in and cut the dividend. Where, one is that he ran a Canadian bank, and if there's any, investors besides telecom investors that love their dividends, it's Canadian bank investors. So there's that. He did grow CIBC's dividends significantly during his time that he was there. And, two is that there's a kind of a turnaround plan in place. Telus wants to pay down the debt, which will, decrease the amount of interest that they have to pay. All of that savings go straight to the bottom line, which should hopefully increase free cash flow and kind of get that payout ratio from above 100% down below 100%. And they kind of project that to happen in sort of like 2027 or so. Now, ultimately, like it comes down to what's he going to do as the new CEO. And I just think it's a little bit too early to say that, hey, this guy's going to immediately cut the dividend. He wants this clean slate. Like nobody really knows what he's going to do. And if I was him, I would certainly go in and I would say, okay, like it's kind of June 30th. I'm here. I'm in. I'm going to wait 6 months. I'm going to come up with a plan, and then in 2027 kind of focus on executing that plan. And hopefully by then Telus's debt will be a little bit lower, and he'll kind of have a little bit of flexibility in order to do that. So is it possible the dividend could get cut? Sure. Okay. Will it get cut? I think at this point it's no certainty, and probably patience should be what I'm doing with my Telus shares anyway. I'm not in any hurry to sell or anything. I'm just going to be patiently wait and see what happens.
Yeah, I think that's a very good point, Nelson. I know I talked about that. They're probably going to cut dividends, but again, you made some very valid points where it takes the CEO. It's going to take some time for him to come in and kind of figure out the company and such, right? So I don't think it's going to be a knee-jerking reaction, and I don't think it's going to be as drastic as 50% cut. Or I think if they cut it, it'll be going to be small, because Telus is looking at reducing their debt by maybe selling some assets and things like that, and workforce reduction, etc. So there are different levers they could pull to reduce their debt and not necessarily just cut dividends right away. So yeah, I think you have the right points there. Do you have anything else to say about Telus, or should we move on to another stock.
I just wanted to say that, it was definitely the knee-jerk reaction of, I'm going to call it like FinTwit, which I think is one of the advantages of being on Twitter, is that you get to see like kind of what the market thinks. And that was sort of the knee-jerk reaction, that exactly what you're saying, Bob, is that like the belief is that this guy's going to come in and just slash the dividend. But, ultimately at this point, I think that the potential for a dividend cut is probably priced into the stock. Like, everybody knows, if you're paying attention, that the dividend payout ratio is too high, and that they're doing some things to try to pay down debt in order to get that to a more acceptable number. So if Telus does cut the dividend, I don't think there's going to be a massive reaction in the stock. I think a lot of people kind of realize that that's a possibility, and they won't just immediately go out and sell their shares. I think the people who are very concerned about a dividend cut have already sold their shares or will sell their shares before that dividend cut happens, which I think is probably a year out if it happens. But anyway, let's pivot to, I don't know, I think we should talk about the Canadian banks, because they're going to be very, very popular for our listeners. When we did our top 5 positions, that was, I don't know how many episodes ago, but both of us have a lot of Canadian banks in our portfolio. So Bob, are you buying the Canadian banks today? Are you like excited about buying them, or do you think that they're maybe a little bit too expensive?
I'm just kind of laughing in silence, because that you read my mind exactly, because I was going to talk about Canadian banks before you brought it up. So yeah, I think it's harder to find value in Canadian banks, as they've been kind of going at roughly around 52-week high. But just because they're at around 52-week high doesn't mean they can continue to go up. You look at TD and Royal Bank, I think they're solid purchases regardless. Yeah, I would kind of nibble and a little bit here and there on TD and Royal Bank. For myself, I certainly have bought some here and there, maybe not like significant amount, but just kind of on the day the share price is down a little bit and I have some money, I may go in and buy some. Even like the likes of CIBC, Bank of Nova Scotia, Bank of Montreal, National Bank, I think they're all pretty solid. Now, you could set aside some money and just wait for a pull back, but it's hard to determine when these pullbacks are going to happen and such. So, my rationale is kind of, if I have money, I try to stay invested as much as I can and collect the dividends, right? So that's kind of my train of thought. Nelson, would you buy some more Canadian banks nowadays, given the price?
Yeah, so my strategy for a number of years now when it comes to the Canadian banks has been that when a Canadian bank hits a 52-week low, I'm in there buying it. I think that that's just the perfect kind of simple rule that works. And yes, sometimes there's a 52-week low, and then all of a sudden 2 weeks later, there's another 52-week low, and then another one. And, it doesn't always work out perfectly well. But for the most part, that's been a very successful strategy for me. I bought aggressively in, 2020, in 2023, and then in 2024, 2025 with TD, when they were having their problems with their US, so the fine and everything they got there, is that I was buying that one there as well. And all those have been very successful positions for me. I couldn't be happier. And so now it's like, okay, so what do I do when they're at 52-week highs? And the answer is, well, I just sort of sit on my hands and I just kind of wait until they're unloved again, and then I would look at them again. But the problem with that strategy is that I already have large Canadian bank positions. Top 5 of my portfolio is dominated by Canadian banks. So what do you do if you don't own any right now? It's like, that these are terrific stocks, have grown investor wealth for a long time. You want to get in, but they're at 52-week highs. What do you do? And I think that it's probably never a terrible time to buy Canadian bank stocks. So I don't, hate the idea of kind of nibbling on them a little bit here and just saying, hey, I'm going to buy a little bit and then I'm going to wait to maybe like average down or whatever if it happens. Because if you look at the super long-term charts, these like 50-year charts, is that their Canadian banks have 5 to 10-year periods in the past where they just kind of quietly march higher without any real pullbacks. Is that going to happen over the next 5 to 10 years? I don't think so, but you never know. So the point is that like, if you don't own them already, sure, you can kind of nibble a little bit, but I think that perhaps doing so today, you've kind of locked yourself into maybe like an 8 or a 9% long-term total return versus waiting until they're lower, where you could probably get sort of a 10 to 12% total return over time. So ultimately it's like, okay, well, if you're okay with that type of result, it's got a low risk, which I think the Canadian banks offer, then by all means. And if not, move on to something else that might be cheap or beaten down or whatever. But the problem with that is that there isn't a whole lot that's really cheap or beaten down right now, is there, Bob?
No, and just adding to your point, Nelson, like if you look at Royal Bank, if you look at a 5-year chart, it's basically been going up. Right? There's a few downturns where I think looks like 2022 went high and then it dropped down a little bit, and then it kind of went down a little bit more to kind of 52-week low sort of end of 2024, and then since then it's been going up, right? So if you bought it at the high of, I think it's around $150 in 2022, thinking, oh, I'll just nibble a little bit, and then the share price has been went down for about 2 years, but you were still collecting dividends. So as long as you're being patient, and when these Canadian bank stocks are down, I think it's a great opportunity to purchase them, right? Like we purchased TD, like we backed up the truck on TD in 2020, same as other Canadian banks, 2021 again, 2022, 2023, 2024. Basically every single year we've been kind of strategically buying more Canadian banks. And I get it, when it's 52-week high, and if you don't own any banks, it's hard to get started. And you're always wondering like, oh, is it a good idea? Is it going to drop? Right? Like we don't know. We don't know what we don't know. But if you look at the Canadian bank, like Royal Bank chart, if you were to buy in 2024, that like early 2024, that was around 52-week high, around $130, right? That was, in early January, $130. That was at 52-week high. But then since then, it's been going up. Like it's around $230 per share today when we record this. So, even you bought it at 52-week high, you're still doing pretty well, right? So there's some, you don't necessarily have to buy a 52-week low just to lock in that gain. You just, if a stock has momentum and the company is operating well, generally speaking, the share price is going to reflect that. So that might be a way to do that. Like if you're just starting out and you want to get into Royal Bank, for example, then maybe buy a few $1,000s worth of Royal Bank and then wait for 3 months or 6 months, and then you could just go in and regularly buy it at set interval. That's a good way to dollar cost average, right? Or have some money set aside, so when there's a drop, then you go in and buy some. So that's probably a strategy that we've been utilizing nowadays, right? Just kind of nibble here and there kind of thing.
And it's a very valid strategy. Like, you talked about that kind of in early 2022. I pulled up the chart while you were talking there, and in early 2022, it hit an all-time high of 150, and then it kind of traded below that up until sort of the latter part of 2024 there. So you look at it and it's like, okay, well, there's 2.5 years of zero returns, but the stock has gone from 150 to 230, which is a more than 50% return in, let's call it 4 years, plus your dividends. So the dividend would have been, say, an extra like 20% on top of that. Maybe not quite that much, but the point is that like you would have bought it at that 52-week high. You would have had a very acceptable total return over that period. It wouldn't have been spectacular, it wouldn't have been like 20% a year or anything, but it's certainly good enough to grow your wealth and do fairly well at. So Bob, you're absolutely right. Like, there's nothing wrong with buying them at highs because the Canadian banks just very quietly compound behind the scenes over time. And just keep doing that. So agreed. Nothing wrong with that strategy. I have my strategy works for me, but that doesn't mean that you should just blindly follow it. By all means, like buy some at 52-week highs. It can certainly work in your favor.
Just wanted to add something like with social media, there's a lot of call it newer investors. There seems to be a tendency of like chasing these very, very like high beta stocks where it could go up, 10% in a day kind of thing. It's like super volatile. And yeah, it's exciting, but at the same time, you're probably better off sticking with like boring, steady stocks. Like you don't grow your net worth. Like building wealth quickly is a disaster waiting to be to happen, right? Like you want to build your wealth slowly, steady over time, right? Like I think I've seen this picture floating somewhere on social media. It's kind of like baking a turkey for holiday dinner, right? You want to bake your turkey at relatively low temperature for a long time, so it's like juicy, moist, and crispy on the outside. Imagine you bake your turkey for 700 Fahrenheit for 30 minutes. It's everything's going to be like black. Yeah, is it done inside? Yes, but it's not going to taste good. So that's kind of an analogy in terms of building your wealth over long term and slow and steady rather than try to pick these hot stocks and then very volatile and react to the social media trend. I think that's a danger of checking too much social media because you fall into that trap.
Definitely. There's always going to be someone that gets richer faster than you, but like, who cares? Like it's not a competition. It's not, you don't have to get rich quickly. And like you said, it's generally a disaster. There's a Warren Buffett quote that I was thinking about as you were talking, where it's, you can't produce a baby in a month by getting 9 women pregnant. Like it doesn't work that way, and investing doesn't work that way. You can swing for the fences, but eventually, like when you you just swing for the fences over and over and over and over again. Well, soon enough, you're going to swing and you're going to miss. And that is just a huge impact to your portfolio that is really hard to recover from.
Yeah. So we're getting off topic a little bit. Let's get back to the main topic here. So Nelson, I know when we talked a few episodes back, you mentioned Capital Power is one of your largest portfolio. It's been down a little bit since we talked. Or are you still thinking buying more? Like what would you do with Capital Power? Are you monitoring closely? What's going on there?
Yeah, I'm holding Capital Power right now. I'm happy to hold. The thesis, of course, if anyone's not familiar with Capital Power, this is mostly a natural gas fired independent power producer. So these guys buy power plants, and then sell the output to the various utility companies, and then eventually that gets consumed by us. I live in Edmonton. There's a large capital, but there's actually 2 large Capital Power plants about a half an hour down the road that provide most of the power for the city. They used to be coal-fired, and then they were converted into natural gas. So this podcast is literally powered by Capital Power. What I like about it is that they can acquire natural gas power plants at fairly attractive kind of return profiles because nobody really wants natural gas. Natural gas is kind of this weird sort of transition between coal and renewable energy. Of course, nobody wants coal. It's dirty, pollutes, etc. Everyone's excited about renewable energy, and natural gas is just kind of this weird thing in the middle that I think we're going to use for a while until kind of renewables are ready to establish that load. There's electricity that we have to have all the time, and renewable power just can't provide that at this point. Anyway, Capital Power is very cheap on a sort of price to AFFO ratio. I think it trades at about 8 times. AFFO is sort of this proxy to free cash flow. So it's cheap. It pays a attractive dividend. I think the payout is more than 4%, maybe not quite 5% anymore. It grows the dividend. And the other thing is that Capital Power is sort of this proxy on data centers. AI needs data centers. These data centers need a lot of power. So I kind of looked at it from this kind of very top-down approach where it's like, okay, who's going to be the winner in AI? I have no idea. But like any sort of gold rush, well, the winner is usually the person that sells the picks and the shovels to the miners. And in this case, the picks and the shovels is power. And natural gas is a fantastic choice for data centers because it's just this steady power approach that the data centers need. Anyway, I'm happy to hold it. I don't think it's super cheap right now, so I don't want to buy any more. You know, maybe I'm a little bit biased in the fact that I bought the vast majority of my position at about $30, and I think it's closer to $60 as we talk today. So I'm sitting on a nice gain on that one, and I'm just kind of happy to hold it at this point, but would be very excited to buy more if it kind of had a sustained sell-off. Bob, do you own this one as well?
Yeah, we do own Capital Power, and we've been kind of nibbling on it a little bit here and there. You know, I think long-term Capital Power will be fine. Yeah, natural gas is not the sexiest thing, but reality is we need more power, and you know, with the data center and such, power is much needed. I think the stock did a little bit of pullback because there's this whole AI scare within the sectors, like, oh, it's growing too fast. People are investing too much, and you know, there's a bit of knee-jerk reaction again. So the share price has retrieved a little bit, but I think long term is going to be just fine, and you know, it's paying pretty healthy dividends. So that's one where you just buy and then kind of forget it almost, especially as a utility company. I like utility companies in the sense that you can just buy and then leave it and kind of forget it. They'll just check along in the background, and you don't really need to pay too much attention to utility companies. So that's my thoughts.
I tend to agree. I was just going to say that that's the beauty of a company like this one. You can just buy it and forget about it, put it in the background, live your life, and chances are you're going to wake up, 5 years from now, and it's going to be higher than it is now, and it's going to pay a healthy dividend in the meantime.
Yeah, so I wanted to talk about a couple other companies. So I know a lot of my blog readers are looking to Brookfield Asset Management and Brookfield Corporation. I interviewed a reader, oh God, many years ago. I think he was making, can't remember exactly, like over 200K in dividends, and he shared his portfolio with me just privately, and he definitely owns a lot of Brookfield. This was before the split, right? So that one has always been one, like, I've been trying to build up our holding in Brookfield Asset Management and Brookfield Corporation for a few years now, and I think I'm bullish these two companies. So just for readers that are listeners that are not familiar with Brookfield, so in 2022 there was a spinoff, right? So previously it was called Brookfield Asset Management, BAM. And then there was a spinoff in 2022. So then it became Brookfield Asset Management and Brookfield Corporation. So the way you could think of is it's structured differently, right? So BAM, the asset management, funny enough, is actually the asset-light fee machine. So it's the asset manager, and Brookfield is the holding company, right? So you think of Brookfield as like the company that actually owns the assets. The BAM is the company that manages these assets and collect fees. So, and then Brookfield owns about 75% of BAM. And if you look at the Brookfield structure, it's very, very complicated. But a few things, the few differences between BAM and Brookfield, right? So BAM is, again, it's managing it's the management. And what I like about both of these companies, they being able to grow significantly, right? So BAM, the asset under management more than double from in the past, and then they're expecting to double from about 25 trillion in 2022 to roughly 60 trillion by 2030, right? That's their plan, and they've been like Brookfield Asset Management has been growing dividends as well. So it's it's a good company to hold, I think. And then Brookfield Corporation essentially is called it the mother company, right? Holds all the assets. So it's growing a lot of assets underneath and acquiring attractive assets. So it's quite attractive overall. Obviously, if you're a dividend investor, BAM is more attractive because the yield is a little bit higher, I think between 3 to 4%, whereas Brookfield Corporation, BN is much lower, is less than 1%. But I think we talk about yield versus growth. Brookfield Corporation would definitely have more growth, right? More price appreciation. Of course, BAM is more on the dividend side, so you kind of have to pick one or invest in both. Nelson, do you invest in any of these?
For a while there, the whole Brookfield complex, and I call it the Brookfield complex because, like you said, Bob, the whole thing is just a little bit complicated. I threw it on my too hard pile because I just looked at it and it was like, okay, the mother company, Brookfield just owned a whole bunch of stuff, and I didn't think that the stuff they owned was bad by any means, but it was just sort of complicated, and I figured that it would always kind of have this conglomerate discount. That's always been the bull thesis, at least for the last few years for Brookfield, has been that it owns a bunch of this stuff, and that if you were to sell off the stuff, that you would get more money than what Brookfield shares were currently at. And so I kind of looked at that and I was like, I didn't love that kind of that bull thesis, but then I dug a little bit deeper into it. I think it was like kind of early 2024. And what I realized was that I really liked BAM, the asset manager, because I figured that there's kind of like more and more money is going to flow into Brookfield because investors are looking for kind of the returns that Brookfield can offer, and kind of these, Brookfield really specializes in kind of these very physical, tangible assets. Like they own real estate, they own power companies and power infrastructure via Brookfield Renewables, and they own like infrastructure assets via Brookfield Infrastructure Partners. And I liked these kind of assets. And so I looked at it and I said, okay, well, I think that the money that flows into Brookfield, into these other companies, is just going to increase over time. Therefore, the asset manager is going to grow. And the asset manager has pledged to pay out the vast majority of its earnings as dividends. So as the earnings grow, the dividend is going to grow. And I was happy to hold that one. So I've been a BAM shareholder now for probably 2 years. Actually, I just recently bought more at around the $65 level. I think that 4% yield, which it gets to kind of every now and again, is a nice entry point. And yeah, that's one that I plan to hold for a long time because the long-term bullish kind of thesis that you outlined with Brookfield, Bob, I think it's very relevant. And I think whichever one you choose, whether it's Brookfield or BAM, you're going to do just fine over time.
100% agree. And there's no reason why you can hold both, right? That's what we kind of do as well. Like if I look at our portfolio, maybe we hold a little bit more BAM right now than Brookfield, but it's like dollar-wise is a very small difference. I know we're kind of getting close to time, but we only really talked a few stocks so far, so I kind of wanted to talk more, kind of doing a lightning round just because we're kind of short on time here. But a few ones I want to talk about would be, I know a lot of listeners and readers my blog are always curious, so I'll just list a few and then we could talk, right? So Manulife, the pipelines, so Enbridge, TC Energy Corp, and then one that a lot of people have been asking is Mentation Tushtar. That one is on a lot of people's radar. Nelson, do you have any other ones you want to talk about? One thing.
Sure. Maybe I'll quickly kind of talk about the ones you mentioned just real quick. Pipelines, I think, are fantastic, great companies. Just wouldn't buy them today. They've gone up too much too fast. Couche-Tard, I think, is a wonderful company. And now that the 7-Eleven kind of overhang is off them, I thought that was a big acquisition, too much to chew. And I'm really curious what they're going to do next. I think that bolt-on acquisitions make a lot of sense, and they can do that. And then Manulife, that's another great company that has gone up a lot, but I think that it's probably not super expensive considering the growth they kind of get in Asia as well. So Bob, weigh in real quick, and then maybe I'll pick a few that we can do for the lightning round.
Yeah, so Enbridge, TC Energy Corp. Yeah, agree with you. I think at the time of recording, they just came out with their earnings, and both stocks have jumped since the earnings. So yeah, I wouldn't buy more. We own quite a bit of Enbridge and TC Energy Corp already, so we would just collect dividends and maybe drip dollar cost average kind of thing. So I wouldn't buy more Enbridge or TC Energy Corp, just like you, Nelson. Tushtar, we own. It's not a huge amount that we own, but yeah, I think the whole 7-Eleven thing is behind them, and that was just not a good acquisition overall, just too complex, and they were being too ambitious, I think. But yeah, it would be interesting to see what they plan to do next, because they've been acquiring other companies throughout history and grow that way. So I don't know who else they could acquire, but we'll have to wait and see. But Tushtar would be good. And then Manulife, I think they just increased their dividends by 10%, which is quite significant. However, the share price went down because there were some concerns about their growth or something. But I have no problem with Manulife. I think it's still relatively cheap. I mean, Manulife was one of the first stocks that we own. I think I mentioned about that many times, and we plan to continue to hold Manulife for the foreseeable future and just hold on and then buy more when we think it's attractive enough, right? So yeah, so hopefully that's my thoughts. Nelson, do you have any names you want to talk about?
Yeah, I want to ask you about three. One is the railroads, so Canadian National or Canadian Pacific. Maybe if you could talk about if you have a favorite of either of those. And then a couple more on kind of the growthier side is Intact Financial and Constellation Software. Constellation Software has gone down a lot. There's strong opinions on Constellation Software. So yeah, I'd like to hear what yours is about Constellation Software, Intact, and then the two railroads.
Yeah, let's talk about the railroads first. So we own Canadian National Railway. We don't own CP. I actually bought some more Canadian National Railway early this year with our TFSA contribution. So looking at it, we got in around like mid 130s. Kind of recording is like 146. So we're up a little bit, like less than 7%. So it's not like the high riding NVIDIA or these, but 7% since January. We're recording in February, so that's gone all right. I'll take that. Right, the railway's been struggling because the whole tariffs. There's a lot of concerns about tariffs, and because they transport goods, that's eating into their overall revenues. But let's be frank, the railways are not going away anytime soon. If anything, I think the railways are going to outlive the current U.S. administration, right? Because it's 4-year terms and politics change. So I think long term, both the railways would do just fine. And if you look at transportation, like goods and transporting goods across North America, is still too expensive to transport via airplanes. So railways is probably one of the most efficient, cost-effective ways to transport goods across North America. So we still rely on railways quite a bit. So I would continue to buy them as long as the price is attractive enough. The other one, Intact Financial, that was one of the first stocks that we bought. I think we bought it before financial crisis, and we have returned quite a bit, and it's been increasing dividends pretty much every year. I can't remember what the dividend streak is now, but yeah, no problem buying Intact Financial. I think it's now at around 52-week low. If you don't own it, I would go in. We haven't really bought more. We just been dripping here and there. Would I go in and buy like another big chunk of Intact Financial? Yeah, probably. Looking at our, yeah, like I like Intact Financial. It's one of the stable companies and just making money left, right, center. Constellation Software, we don't own them. We don't really follow too much of it. I don't know. I working in high tech, I don't really follow too much high tech company other than the big ones. So I honestly I don't know too much about Constellation Software. I know it's been high writing and it's building like SaaS software. I think the drop has been more caused by fears with AI and how they're investing so much money and so on, right? So again, I don't know too much about it to talk about Constellation Software. Nelson, what about you?
Bob, you've got to be the only guy out there who doesn't have an opinion on Constellation Software. It's amazing how polarized the opinions are on it. The bulls are very, very bullish, and the bears are sort of, very, very bearish. The one thing I'll say about Constellation, I'll say two things about Constellation. One is that I think it's funny how the same guys who think it's a fantastic buy at, as we're recording this, it's about kind of $2,300 a share. I think the guys who loved it at $5,000 a share also love it at $2,300 a share, which immediately makes me a little bit nervous because they got it so incredibly wrong at that point. Also, someone on Twitter was saying that, hey, maybe like the dividend guys need to be interested in Constellation Software. And the big reason why I don't buy it and I'm not interested is because Constellation Software is not a dividend stock. It pays a token dividend to get on the dividend lists or, so that the dividend paying mutual funds can be interested in it. But other than that, it doesn't grow the dividend. The dividend is clearly not a priority for them. Therefore, like for me as a dividend investor, it's not inside my investing universe. Okay, so saying that, two stocks that are in there are the two railroad companies. I own both of them. I've owned both of them since probably about 2018, 2019. I think that the railroads are excellent companies. Bob, you said they're going to outlive the current administration. I think they're going to outlive like you and me. I think in 50 years from now, the railroads are going to continue to transport goods to and from, the coasts, from ports, etc. And what I really like about the railroads is that it is a very physical moat that you can go and you can touch. You can walk along the railroad tracks. Probably not a good idea because there's a lot of trains on there, but you can walk along the tracks and it's just, I love it. I love that you can see the moat. Like you can see it, like Edmonton, the train tracks go through Edmonton, just like they go through Vancouver. And it's like, wow, like this is good real estate that these trains have. That advantage is not going away. And then finally, Intact. I haven't owned Intact nearly as long as you, Bob, but I bought it in, I think 2020, 2021. And it was my car insurance kept going up every year. I don't have Intact as my car insurer. I know I should probably switch, but it just kept going up every year. And it's like, when we talked about hedging your consumption, I was like, I think that auto insurance is generally a pretty good business because they have the ability to increase prices to me and pretty much everyone I know almost on a yearly basis. Sometimes the pricing isn't as firm and they don't increase, but for the most part, they increase on a yearly basis. Therefore, that's probably a pretty good business. I should buy some of it. And I was up kind of more than doubled on my shares of what it was at its peak. It's come down a little bit off the peak, so I'm probably interested at this point today. I'm like you, I'm thinking about buying more. Anyways, Bob, I think we're out of time.
Yeah, I just wanted to add Constellation Software. I kind of looked up the price. I had no idea it dropped from around almost $5,000, over $5,000 down to, I think at time of recording is under around $2,300. So it was a significant drop. But I think, yeah, being a software company, there's a lot of concern about AI being able to write code and replace a lot of these software. So, and that's probably one of the reasons why a lot of these software company share price has been down a bit. Is that overblown? I think so. It's getting easier and easier to develop software with AI, and you could code easier. And that initial investment is not as big now compared to 5-10 years ago. But that also means the software company could develop software faster. They could utilize AI, and they don't have to hire as many engineers. So you can't just say, oh, AI is going to replace these software companies. They do have intellectual properties, right, with their software, and that's something AI may not be able to develop or replace, right? So there's some stuff you need to consider. Again, I think I don't follow Constellation software just because I just don't. For some reason, I know it's discussed a lot on social media for sure, but I try to step away from those because I just think it's a waste of my time. Would I buy some at this point? I don't know. I think just looking at the chart quickly, P is at 55, which is extremely high. Dividends really low. It's not a dividend stock. Yeah, sure, they pay dividends just like what Nelson said, but the yield is so low it is not attractive at all for dividend investors like us. The only reason I would buy some is if now the share price is down quite a bit. Maybe there's potentially opportunity for that to rebound back. But I don't know. It's a bit of a gamble. I don't know the company well enough. I would definitely need to read their financial reports, annual and quarterly reports, and then make up my mind. So don't plan to invest in Constellation software at this point.
Well, Bob, the good news is there is no lack of information out there on Constellation software. If you want to read about it, it seems like 1 million guys who have made it their entire personality. So there's lots of stuff on there if you're interested. But I am going to wrap it up because I think we're a little bit over what we normally do. So, sorry, folks, but I think it was a good discussion. I don't think anyone's going to be too upset about us going over a little bit on this one. Bob, as always, a pleasure. And everyone, appreciate you listening each and every week. I'm constantly surprised at how many people we have that are subscribing, that are tuning in every single week. We appreciate all of you. Thanks a lot. And of course, as always, check out Bob's blog. That's talkan.com or me at CanadianDividendInvesting.com. Thanks, everyone. See you next week.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at talkan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Talkan or CDI Newsletter. Thanks. See you next time.